If you own a corporation and regularly transfer money from the company to yourself whenever you need it, you need to hear this. Taking money from your corporation is not the same as taking money from your personal bank account. That withdrawal needs to be properly accounted for. And if it isn't, what looks like a simple transfer could create an unexpected personal tax problem. Hi, I'm Us Melbourne, founder of Melbourne Accounting Solutions. Today we're talking about something many incorporated business owners don't fully understand: the shareholder loan account. This is one of those areas where poor bookkeeping and poor tax planning can combine to create a very expensive surprise. So let me explain it in plain English. Imagine your corporation has $150,000 sitting in the bank. You're the owner. You need $40,000 personally. So you transfer $40,000 from the corporate account into your personal account. You think, it's my company, it's my money. But from an accounting and tax perspective, we need to know, what exactly was that $40,000? Was it salary? Was it a dividend? Was the corporation repaying money it already owed you? Was it reimbursement for legitimate business expenses you personally paid? Or did you just borrow $40,000 from your corporation? Those answers can produce very different tax results. Here's the concept every incorporated business owner needs to understand. You and your corporation are not the same taxpayer. The corporation has its own assets, liabilities, income, expenses, and tax obligations. So, when money moves between you and your corporation, that transaction needs to be properly recorded. One account accountants commonly use to track these transactions is the shareholder loan account. For example, if you personally pay legitimate corporate expenses, the corporation may owe money to you. But if you withdraw corporate funds for personal purposes without those amounts being properly treated as salary, dividends, reimbursements, or another appropriate transaction, you may end up owing money to the corporation. And that's where the tax rules become important. Canada's Income Tax Act contains specific rules for certain loans and debts involving shareholders and corporations. Depending on the facts, a shareholder loan that isn't dealt with within the applicable rules can potentially result in an amount being included in the shareholder's personal income. There can also be taxable interest benefit issues, where a shareholder receives a low interest or interest-free loan. And here's something particularly important. Simply repaying a shareholder loan and borrowing the money again may not necessarily solve the problem. The legislation contains rules designed to address certain repayment and reborrowing arrangements. That's why shareholder loans should never be treated casually. Why bookkeeping matters. This is also why accurate bookkeeping is so important. Imagine making personal withdrawals throughout the entire year. $2,000 here, $5,000 there, a personal credit card payment, a mortgage payment, a family vacation, another transfer. By year end, nobody remembers what half the transactions were for. Your accountant now has to reconstruct the story. And sometimes the story reveals a large amount owing by the shareholder. That's not where you want to discover the problem. Owning the corporation doesn't mean every dollar in the corporation belongs to you personally. Corporate money needs to leave the corporation for a properly understood and recorded reason. Before transferring corporate money to yourself, know what the payment represents. Ask, is this salary? Is this a dividend? Is the corporation repaying me? Is this an expense reimbursement? Or am I borrowing money from the company? And throughout the year, review your shareholder loan balance. Don't wait until your accountant prepares the year-end financial statements to discover that you owe your corporation a significant amount of money. At Melbourne Accounting Solutions, we help incorporated business owners understand how money is moving between themselves and their corporations. We can review shareholder transactions, compensation strategies, bookkeeping records, and potential tax implications before year end. If you've been transferring money between your corporate and personal accounts without clearly knowing how those transactions are being recorded, let's review your shareholder loan account. The earlier we identify an issue, the more opportunity there may be to properly address it. Good tax planning happens before the problem reaches your tax return. Open your corporate books and ask yourself, right now, does my corporation owe me money, or do I owe money to my corporation? If you don't know the answer, that's one number you should find out. I'm Us Melbourne, founder of Melbourne Accounting Solutions. Our mission is simple: to help Canadian business owners make smarter financial decisions, reduce unnecessary taxes, and build stronger businesses. If you found this lesson valuable, please subscribe to our channel so you never miss future Canadian business, tax, accounting, and financial insights designed to help you succeed. And if you're an incorporated business owner who's been moving money between your corporation and personal accounts without a clear strategy, contact Melbourne Accounting Solutions. Let's review your shareholder loan account before it becomes a tax problem, helping Canadian business owners learn, grow, prosper. Thanks for watching, and I'll see you in the next lesson.